We get into what happened in the markets over the last 3 months for my market commentary for the third quarter of 2020. Let's get into it. I'm Joe Macy, Portfolio Manager with Hollis Wealth. And as of this writing, we've pretty much just gotten through the summer up until the end of September and the first few presidential debates between President Trump and Joe Biden. And we will go through the melt up over the summertime, the meltdown in September, and what I think contributed to these, plus the updates on potential new stimulus bills, expiring eviction laws, and the illness which has infected the president, along with the First Lady, along with several White House staff, and was coming down the pipe, and my thoughts as to where the next irrational bubble may be developing. But before we get into it, I'd like to mention that while I am fully licensed in the areas of investments and life insurance, and I have over 2 decades of experience helping many clients, I'm not licensed in any other areas. And so with that being said, this video and any other video I produce should be purely viewed as educational for general information purposes only, and it should never be viewed as actionable advice in any specific area. So please, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. The other thing you need to do is hit that like button for the YouTube algorithm, as it really helps out my channel. And if you like my content and want to be kept in the loop with all of my newest videos, I'd be thrilled if you would hit that subscribe button and darken that notification bell. So as you know, during the course of this year, we entered a market where it was unclear whether or not we would melt up or melt down, as there were just too many variables to consider when trying to make a forecast for the rest of the year. And my concerns surrounding the overvaluation of the market in general have only risen over this time frame. June, July, and August saw the markets melting up, and it seems we have a pretty good explanation of what happened with the actions of SoftBank and the retail investor. You see, I really wanted to cover this story as I believe it's a story worth mentioning, as SoftBank not only went long the markets in April, they bought roughly $4 billion worth of call options contracts on the market. This also seemed to be echoed with additional call options contracts being bought in droves by the retail investor as well. Why is this so meaningful? Well, when options contracts are purchased, if there is not enough volume, the market makers will essentially make a market for them and allow for the volume of contracts to be sold to the buyers. However, they won't do that without hedging the books by covering themselves with the stocks. So they will sell the options, but they will immediately buy the stocks underneath to hedge their portfolios and likely initiate hedges underneath that to guard against downside risk. In short, the more call options that are bought, the more the underlying shares have to be bought to offset the risks, and as options are based on leverage, one contract is typically worth 100 shares. You can now imagine that by buying this level of volume in call option contracts would likely lead to a massive purchase in equities to offset the risks. But according to this article from the Financial Times, and I quote, "The whale-sized trades have stirred theories that SoftBank intensified the summer rally in the US tech stocks. However, the whale SoftBank trades, while they were huge, may have paled in comparison to the retail investor, as put by Dean Kernot, the chief executive of Macro Risk Advisors, whom said those millions of retail traders form a mighty call trading legion, with a combined heft bigger than even giant financial institutions." Quote, "My take is that it's less SoftBank driving options markets, and it's more this collective activity of retail momentum-oriented crowd. The data just doesn't have a mark of a whale. It has the mark of lots of little tiny whales that add up to one big one." This also seems to be correct, as the more and more I observe YouTube content on investing, the more and more I see options videos are being produced, with more and more of the retail investor seemingly participating in them. Either way, the vast options volume is likely what helped contribute to the market melting up over this summer. However, we also had another huge factor play into the markets melting up this summer, as we had one of the single largest short positions on the S&P 500 ever recorded virtually evaporate to one of the lowest short positions ever recorded. If this wasn't enough, we also have had some pretty negative news stories arise, such as the eviction Emissions Protection expiring, the CARES Act expiring July 31st, and as of this writing, still no new stimulus bill to replace the old one, as Congress has not been able to come together on a number in order to support the millions of Americans that are still out of work. Now, just because we've seen the markets melt up doesn't mean it's all equal. We have also had one of the most deceiving and fractured markets I have ever seen, with the S&P 500 appearing to come back to its record old highs. But upon closer inspection, the large cap growth stocks were chiefly responsible for much of the recovery, while the broader value stocks such as restaurants, airlines, cruise lines, and banking continued to vastly underperform the big tech names. Fast forward to September, and we seem to have had a fairly good market cool-off, as September was a fairly negative month, with likely some of the options trades unwinding and increasing uncertainty surrounding the rebound of the economy. Headed into the final quarter of the year, historically, these latter months haven't been the greatest in terms of returns, and as of yet, we have several major things to play out. These things include the presidential election, results of trials of the new vaccines to finally beat this illness, new fiscal stimulus from the government to support the unemployed, and a possible second or third wave of not only the illness, but of the flu and other illnesses that can affect us in the wintertime. Any one of these large news headlines can significantly move the markets one way or the other and increase volatility past what we have seen all year. So what do I see from here? What we have is a Federal Reserve that has provided unprecedented liquidity into the market, and that liquidity over the past 6 months has started to make its way into the economy, and it is slowly starting to support asset prices going forward. I would expect that by the first quarter of 2021, that liquidity will be a main driver of asset prices higher, and I personally will feel a whole lot better about the markets than I do today. Also, I think by that time, a number of these major issues will be resolved, and we can get some clarity and some more certainty surrounding the direction of the markets, which will likely lead to the lowering of volatility in the future. First, the political landscape will be certain as opposed to uncertain. Right now, we don't know whom will be elected and what the House will look like, and while normally I would say this matters less over the long term, I would say how the election turns out will give a better roadmap as to what we can expect given a certain administration in charge. Many polls are favoring Joe Biden to be the next president, but in several elections in other countries, and including in the last election in the United States, the polls proved to be largely inaccurate. For this reason, it's reasonable to assume that anything can happen regardless of the polls, and there is little certainty as to how the political landscape will look for the next 4 years. Second, it's highly likely one or more vaccines are approved between now and the end of the first quarter 2021, and are well on their way to being mass produced. With that being said, a viable vaccine against the illness should give the markets much more certainty and give the confidence for people to start investing in growth for the long term again. However, a working vaccine is only good if people trust it and actually get the injection. If we have droves of people that do not trust the medicine produced, and by that reasoning do not take it, we could see a longer healing process for countries to get back to the old new normal, as travel plans will likely drag. After all, vaccines are produced and tested typically over many years, and many people may feel that this new vaccine to combat the illness may have been rushed and therefore may not fully trust it, and as a result may not take it. Also, rolling out billions of doses to help eradicate the illness will prove a challenge, as we have only eradicated 2 illnesses in the history of illnesses: smallpox and more recently polio. The vaccine story and the illness and how long it lasts will be another variable to consider in 2021. Third, while I do believe Congress eventually does provide an additional fiscal stimulus to aid the economy and help try to speed up a recovery, the longer Congress goes without helping the unemployed, the worse things get for the consumption rate of the US and GDP. As everyone knows, approximately 70% of GDP is the consumer, and with that many people out of work, GDP suffers and so does the economy. Once we can start to believe that we can safely go back to work, travel, and conduct business a little more as we once did, that combined with the massive liquidity injected into the markets and efficiencies born out of the work from home movement should set us up for another long expansion. With that being said, I have some other thoughts for what I think will happen to the economy going into 2021 and beyond. First, I do not think the vast majority of people will work from home permanently. Sure, there will be a subset that love it as they have no more commute times and they can work from anywhere. But in short, I do not think commuting to the office is dead. I do think that businesses will likely reduce lease costs and lease office space on a much more flexible basis to accommodate the new flexible mandate given to employees. I think co-working spaces will become more and more used, and the requirement for people to come into the office will become less, and a more results-based work environment could potentially arise out of this. Why? Because the one drawback of working from home is you don't have the social interaction with groups of people anymore. Going for lunch, conferences, and having personal relationships and experiences with coworkers just can't be built on Zoom calls. And there is something special that happens when you have a physical team building exercise or a conference and camaraderies that are built. The experiences that are built from these are far more powerful. And so I do believe that the flexibility will be a main driver as opposed to the hard office requirements or strictly work from home. Second, I do believe there will be some reasonable pent-up demand in travel in 2021 once we have a vaccine and people feel comfortable traveling again. Third, I also believe I've possibly identified the next bubble forming, in which will likely be any company related to building or creating electric vehicles. It seems the last 3 or 4 companies with any relation to building or manufacturing EV companies has skyrocketed. One company being SPI Energy, which upon making an announcement that they would even be entering the EV market, it soared over 4,000% in one day. And with California banning all gasoline-powered car purchases by the year 2035, the EV race is on. So with all that being said, I'm very bullish on the stock markets past 2021, as a ton of liquidity has been injected into the system. And by that time, there will be a sufficient amount of time passed for that money to flow into the system. But over the next 6 to 9 to perhaps even 12 months, I'm still holding a good amount of cash to be able to take advantage of volatility when it presents itself, as I do think there are still some serious risks of collapse that could happen. I also do have some equity and some hedges still built into my portfolio, which enables me to get a return in choppy markets no matter where they go. My thoughts are to slowly reduce my cash and hedges with purchases into this market over the next 12 months as opportunities present themselves, and strategically over this time frame set myself up for when I think a nice long expansion past 2021 will occur. So with all that, I want to thank you for hearing out my market commentary for the third quarter of 2020. And if you like the content, please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you love my content and want to be kept in the loop with all of my newest videos, I would be very happy if you would just hit that subscribe button and darken that notification bell. Until next time, this is Joe Masek, Portfolio Manager at Hollis Wealth. See you soon.